This is the briefing for the weekend of April 30th. I want to start tonight and kind of review what I've been talking about in the past over the, at least in the intraday briefings in the past week or couple of weeks. Now, this is the spiders on a daily basis, and really it's important to develop a strategy for each day as you come into the markets. And that strategy basically is, if the market does this, I'm going to do that. If the market does that, I'm going to do this. And basically we look at that from terms of price development. In other words, the trend of price in various time frames, or I should say multiple time frames, and price structure. In other words, the strength or weakness of the move. Now, previously in this week, I talked about the fact that markets spend most of their time in rotation. And I think that just looking at this chart, it's pretty relative. I mean, we're going all the way back to September of 2021. You can see that we really have not gone anywhere. We've just been in one big area of rotation. Now, the ellipses that I've put on the chart basically show shorter time frame areas of rotation. So basically we have one greater degree time and price area of pause or area of rotation, and then within that we have shorter term areas of pause and rotation that give us different time frame support and resistance areas. Now, breaking out of an area of rotation is basically vertical development, and that's where we see a trend begin. So on a daily basis, breaking out of this area of rotation right here is vertical development to the downside, finding a stopping place right around the 415 area. Then of course we have a rotation back up again, not quite reaching the 480 area, and then another rotation in a short time frame before we get vertical development. But this is all part of one greater degree time and price counter trend rotation. So looking at this as 1 degree of time, breaking out of this area of rotation, this greater degree time and price rotation, is going to give us vertical development that is much greater in degree of time and price, and typically can be a much greater move in terms of price. So this is why it's important to watch what happens here. So as we were watching here, we knew that the market or the spiders were testing the lower extreme right around the 415 area. We got a double bottom here. It was unable to break through, and then we got the rotation back up again. We got up to this point here. We had 2 days of pause and then a rotation back down, a pause right at the 440 level, and then another breakdown, which testing the 415 down to 410. Now, this candle is the February 24th lows, and it appears that that is now being tested in Friday's trading, and breaking through 410 is going to suggest that we potentially are breaking out in that much greater degree time and price move. Now, that has to deal with price development. So basically, breaking out of here is breaking out in potentially a weekly counter trend rotation to the rally that has developed since 2009, with certain counter trend rotations during that time period, which should be a much greater degree time and price move. Now, as we look at this and we break it down into shorter time frames, you can see that as we moved off of this low into this rally here, that volume was falling off, thus telling us that this rally, while it appeared strong and impulsive from a price development perspective, was really weak from an internal perspective, and there was a divergence in market breadth, as you can see there as well. Same thing happened here as we tried to move higher, and in these 2 days breaking out of this area of pause, it was unsuccessful because volume continued to fall off. Now, as we see coming down into the lows, testing this 410 to 415 area, we see volume beginning to pick up, and it appears that the move is strengthening, and we potentially could see a breakout. Now, as I said at the beginning of this briefing, markets spend most of their time in rotation. So we have to allow for the possibility that we're going to see another rotation back up to potentially test the 480 area or potentially the 460 area, which is this time frame of pause. So basically, strategically for the coming week, breaking through 410, breaking through Friday's low, especially with volume increasing, is going to raise the probabilities that we are now transitioning into that much greater degree time and price counter trend move to the downside, which should be a very good move. On the contrary, if we break through 410 and we see a divergence in breadth, in other words, breadth strengthening and volume falling off, that's going to suggest an attempted and potentially failed attempt to break out, and we'll see rotation back up and back through the range. And that happens alternatively on any rally to the upside. A false breakout occurs periodically, as this attempted to be a false breakout, and then you get rotation back through the range. So for Monday's trading, it appears that the market has strengthened going into Friday's low, and that I should say it's strengthened in terms of the breakout to the downside. Volume is increasing, breadth is falling off, net volume is falling off. The only positive is that the 52-week highs minus 52-week lows diverged going into Friday's low. As you can see here, you can see that it was much weaker earlier in the week and then strengthened somewhat going into Friday's low. But while we want to watch as many internal components of the market as we can, it's going to be important to see what happens on Monday. Watch this 410 area, watch Friday's low. Breaking that, especially with volume increasing and breadth continuing to weaken, would suggest the potential for an impulsive move to the downside. Now, the most recent information is the most relevant, so this goes back pretty far. So we have to look potentially to a weekly or monthly chart to see where the next potential stopping point is, or the market breaking out in this time frame, because the weekly or monthly chart is much older information. We really want to deal with much more relevant information. So the market would have to give us some indication of a potential stopping point. Then how that stopping point develops, how any counter trend pause or rotation develops, will be very important in determining the next degree of time and move in the markets. Now, looking at the NASDAQ, you can see this is the Qs. You can see this area of pause. You can see this area of pause or rotation. And then if I couldn't put another ellipse over these because you wouldn't see them, but if I put another ellipse here, you could see that this area of rotation is valid area also. Now the Qs have broken through this 318 level, and it appears that they are going to move, continue to move lower. Indices closed at the low of the day. That suggests they want to go low on Monday's open, mainly because they would have continued lower if the market had not closed. Now you can see volume increasing in the Qs on this move to the downside, but it fell off slightly going into Friday's close, although net volume was pretty dramatically low as well. Looking at the Russell, you can see these areas of pause, a little bit different than the other indices. And the Russell really has been in an area of rotation for quite some time, I would say. And you can see that right through here. So the Russell has basically broken out of multiple time frame moves and is in vertical development to the downside as well, breaking through this 187 area, closing right around the 185 area on Friday's trading. Volume increasing in the IWM also. So what happened on Friday was we also reached a point of being oversold, but not extremely so. This is an extreme oversold reading in the NYSE. This is an extreme oversold reading in the NASDAQ. So we are oversold, but not extremely so. This would still allow for a continuation of the move lower. So strategically, for Monday's trading, we have to be aware that the higher probability is that we should see follow through to Friday's sell-off. key to that will be watching what happens with the internals in the first 15 to 30 minutes of trading, because if they are not supporting the move to the downside, then that's going to suggest a false breakout and some type of rotation back up again. If they aren't supporting, then we will see that rotation back up again. If we do get a pause at the open on Friday, which would not surprise me, mainly because of the oversold condition, or we could see a lower low and then a pause and then some type of additional move after that. That would give us a pretty good indication of the next degree of move. Important to this is going to be what happens with the support and resistance areas. So keeping in mind that support in the spiders is at the 410 area or Friday's low. The same thing with the Qs, Friday's low, the 318 area. And in the Russell, it's exactly the same. Friday's low up to about the 185 area, 185 to 190. So that's really the crux of where we are. I have to be leaning more towards the short side of this market at the beginning of the week, but I also am aware that the potentially higher probability right now is that we're going to see lower prices on Monday, but there's a smaller probability that we will see some type of pause and rotation back up. My job Monday is going to be determine whether the smaller probability is becoming the higher probability and then taking appropriate action in my trades at that point in time, or whether the higher probability is increasing in its probability assessment and we're going to see some type of potential flush or puking out of shares before we see a bottom. Have a great weekend, and Monday I'll pick this back up again on the intraday briefing.